Hey everyone, thank you for joining us for another episode of The Agent Investor. The goal of The Agent Investor is to have conversations with individuals who are in the commercial and multifamily space to help you all make informed decisions. Today, I have a good friend of mine, Kris Morin, based out of Connecticut, joining us. How are you doing, Kris?
Great, Brandon. It's good to be here. Thanks for having me.
Absolutely. Yeah, Kris is a good friend of mine who I've established a relationship with for the past few years, just through our networking efforts and being part of the same groups. And yeah, so I'm happy to have you here today. As I know Kris is a local syndicator, but I'm going to let him, I'm sure it's much more deeper than that. So I'm going to let Kris kick it off. Kris, tell us about yourself and how you're affiliated with commercial multifamily property.
Yeah, so as you said, right, I'm a syndicator, but it wasn't always so. Like a lot of folks, my journey kind of started elsewhere, and I'll kind of, I'll give you the 50,000 foot view and happy to really go deep wherever. But, real estate was a journey that started for me going all the way back to 2009, right at the depth of the Great Recession. And quite frankly, at that time, I was more focused on flipping single family homes than anything else. I mean, that was the great opportunity. And to be frank, when I first decided that I was going to pursue real estate, you start taking courses, training, whatever you can get your hands on. That's kind of the blueprint that everybody gives you, right? Go flip houses, build up sums of money, and then buy multifamily. And, for the better part of 5 or 6 years, from 2009 to 2015, I was a traveling business consultant. I was on a plane every week going somewhere else in the country. But I had a unique business model that I developed. I partnered with some local universities to give me some college interns, so I had free employees. They basically were my call center. So I sent out a bunch of marketing, right, to high equity homeowners or foreclosure sale, like lots of different leads that we were targeting. And these kids essentially were taking the calls, and it was great because
Well,
these distressed sellers are less likely to swear at or, express anger at these college students. And so I had this whole intake system, and I was doing really well buying and flipping single family homes. Fast forward to 2015, I had realized I'd done nothing more than create another job for myself. Now, don't get me wrong, right? Great, great money, but I was a marketing guy, I was a boss, I was a sales guy, I was a construction manager. I was wearing all these hats. And, at the time, we were in a much different market. We are well past the Great Recession. There was much smaller inventory. I also call that the rise of the guru era. You have all these people on social media saying, I'll teach you how to flip houses, right? And of course,
mm,
everybody has an interest in that, and they saw lots of other people getting wealthy off these discounted properties in the recession. So all these people were coming off the sidelines, jumping into the market, and driving up prices. There were bidding wars on what little inventory was left, and it was just thinning out margins. And you compound that with the fact that I was burning out. I was getting tired of babysitting contractors. I literally remember hanging up the phone. I was in a hotel room in Richmond, Virginia, and this contractor was making my life hell back in Connecticut. And I remember thinking, I don't want to do this anymore. Like, this isn't passive income. This isn't why I got into
mm.
real estate. And so I let all the current projects kind of run themselves out. And I literally I took just about a year off. I was like, I
Oh,
just I need time for me, right? But
absolutely.
that itch came back pretty strong and pretty fast. And that's when I came back more focused on multifamily. I wish that light bulb had went off sooner. So if anybody out there who's contemplating it or they're on a similar path, you can absolutely jump into multifamily, small or large, in the syndication front. Raising money and buying multifamily property is actually a lower risk and much easier than flipping single family homes. But we can go down that rat hole later. But I was fairly successful there. I started buying multifamily, built up a sizable portfolio, and I enjoyed a great deal of equity and income from that for the next 5 or 6 years until COVID hit. Meanwhile, this whole time growing a successful career as a business executive, right? I think you're aware of that, for a large Fortune 200 company in Connecticut. And so I was doing these two things very successfully in tandem. And then COVID hit and drove up all the prices in the inventory. And I had started to think it's time to maybe diversify and hedge a little bit, get involved in some different asset classes, some different geographies. And when the prices went up, it just killed the economics on the small stuff. And so that was kind of
Yeah.
the breaking point for me that said, let me go tackle some of the middle market and large commercial. Because at that point, I had managed dozens, if not 100 plus units on my own, right? I've lots of experience with multifamily. So kind of taking that step was sort of just a natural order for me, right? As opposed to some people who kind of go to a seminar one weekend and come out the next day and call themselves a syndicator. Not picking on those guys, but it's not. If you've never managed a duplex, you probably shouldn't be trying to manage 200 units, right? But for me,
Mm.
that was the launch pad. I built a new team and we started acquiring properties out in the Midwest, and now we are a full-fledged private equity firm that acquires apartment complexes in key markets around the U.S. and back here in Connecticut.
Absolutely. Very good. You threw out a term there, gurus from back in the day when it was the gurus of flipping. Would love to hear you take a little further into conversation about gurus of syndications now, because obviously it's become, kind
Yeah.
of a buzzword. A lot of people are syndicating really, I would say almost anything nowadays, and it's kind of being thrown around, I think, unfairly. But we'll jump into that a little later on. But all right, so let's dive into it. What are some of the biggest myths that you, or common misconceptions about syndications that you hear on a regular basis?
Yeah, I'm going to answer that question with kind of the passive investor in mind, and we could talk
Sure.
about it from the operator's perspective as well. But a couple of things that are just really relevant with where we are in the marketplace right now. A lot of people think when they start thinking about syndications, they automatically start to think about where's the best market to invest. I'll tell you right
Mm.
off the bat, you can win in any market in the US, right? There are strategies working all around you. When you drive down your street in your backyard, those aren't broke landlords that own those properties, right? Or syndicators. Those are very wealthy individuals. There are strategies that work everywhere. You just have to figure out what they are and then exploit them, right? And you learn how to mitigate the risks. So I would just urge folks to think you're better off. It's lower risk for you. You know your local markets better. You can build deeper relationships with brokers and all the key stakeholders that you need in your corner to manage. You could do that better in your own backyard than trying to compete with a guy like me now who has all of those networks and those resources out in the Midwest, right? And so you
Mm.
put yourself in a better position as an operator or investor to do better if you think locally. But I'll tell you, one of the biggest myths behind the best markets, so people do their research and they're told really three things: population growth, job growth, and income growth. And for good reason. Those things are certainly current and future indicators, right, for local economic development and the outlook for that market. But that's not the only thing, right? From an economics perspective, that's where most people draw the line because they just don't understand real estate economics. But it's so much more comprehensive than that. And, I'll just jump to it. If that were true, then markets like Phoenix and Dallas and pockets of Florida, which have an exploding Tampa St. Pete area, right? Those markets would be by and far above the best markets to invest in commercial real estate. And in fact, when you see headlines right now about deals that are going belly up and syndicators who are just handing over the keys to banks and walking away from 2,000 units and investors are losing $200 million, it's in St. Pete, Tampa, Orlando, Jacksonville, it's in Dallas and Houston, it's in Phoenix, Arizona, all the biggest and hottest markets that stole all of the headlines from COVID until current date. Now, why is that? Because people were chasing the shiny objects, right? Where all the new development was
Mm.
going on, everybody was moving, but nobody was paying attention to the new supply. Here's the kicker. That data is publicly available. It's published, whether you can get it through CoStar, you can get it through Moody's Analytics, you can call just the local development councils. You can get a really good read on projects that are under construction, new permits and proposals. So that's work that's coming in the future, right? And so as far back as 2020, I had investors who come to me and say, Kris, I'm not going to invest with you. I'm going to go in this deal in Dallas. And I said, well, let me just, if you're open to it, let me throw a third eye at the pro forma you're looking at, right? Let me just see if I can poke holes in it.
Yeah.
And you're looking at business plans that are projecting 8 and 10% year over year rent growth and all
Mm.
this aggressive stuff. And so they're buying at a real premium. They're overpaying in the moment because they're anticipating this
Yeah.
record growth rate is going to continue. And I say, hey, listen, we'll call him John Doe. Hey, John Doe,
Hmm.
there's a tidal wave of new supply coming. The data is all out there. These guys clearly aren't paying attention to it. That's going to pinch your rent growth, right? And that's going to put downward pressure on the rents and everything else that you think you're going to achieve over that period of time. Now, fast forward 2023, I have investors who, single individual, he was losing $2 million. He had $1 million
Well,
in a deal in Florida, $1 million in a deal in Texas. Both deals were going belly up. They had massive capital calls, and he was trying to right the ship. So
mm,
I say all that to say, big myths, population growth, job growth, income growth alone are not the only indicators. They don't tell the only story. And supply is going to continue to be a constraint for some of those hot markets. Now, don't get me wrong. Those are great markets to invest in if the operators accounted for that data and they bought at the right price and they
absolutely.
factored into their underwriting, right? So I don't want to say Dallas is a good. I'd buy there all day long myself. So that's just
Absolutely.
one myth that I really want to go deeper on. The other thing is groupthink, if you will, or the social media influencers say to you, they'll say, how do you vet a sponsor? Well, you go and look at their history and how many deals have gone full cycle. And so you've got passive investors who find guys who are like, oh, we went full cycle on 3 deals in the last 8 years. Well, the funny thing about the market, it was so strong everywhere. It made heroes out of failures and losers, right? There are a lot
Mm.
of deals, if you were to really pull back the curtain and look at what did they project versus where they really landed, they landed in a great spot simply because natural appreciation alone put them in a really good spot. So they were able to wipe the sweat off their brow and go, wow, we got lucky on that one. And
Yeah.
so if you're looking at full cycle deals, that doesn't tell you that they understand economics and real estate, that they manage an asset well. You really want to get those operators to really pull back the curtain. If they're not willing to show you their original pro formas and their actual profit and loss documentation in terms of where they were on rents and expenses, etc., chances
Mm.
are they're lying to you and they're not really successful at what they're doing. We are within a very small margin of error on everything that we project and where we land. I'm just going to put that plug out there for any investors looking for a new
Yeah,
operator. We've been really
for sure.
fantastic in that regard. And then kind of overlapping with that, I think a lot of people mistaken door count for experience and expertise. So what does that mean? So they might look at
Hmm.
me and say, okay, Chris has done 200 doors, so to speak, in the last 2 or 3 years. Great. Not a lot when you compare me against some of the titans out there who might have done 2,000. And so they say, okay, those guys must know what they're doing. They have the networks that Chris does. I'm going to go invest with them. And a lot of these guys, they had the networks and they had some things going for them. And sure, they were able to step their way into some deals pretty quickly.
Yeah,
But those are also the guys that are making the headlines. They grew too fast. They didn't know where the landmines are. They're stepping on them all over the place, and deals are going belly up. So it just, you got to really sort of, take everything you're hearing online with a grain of salt. And
absolutely.
like I said, if the operators can demonstrate that they have a real deep and broad understanding of real estate economics, they're willing to show you the financials of past deals, and then you just your gut instinct on who they are as an individual, I think it's going to go a long, long way. So that
Absolutely.
that was a long answer, but
That's okay. And I'm kind of going off script here, but I've heard the term that even in the tornadoes, something like even in the tornado, turkeys can fly. And that's kind of what's happened over the last few years. I mean, in every aspect, even in small multifamily, just looking at it from a very micro perspective, same thing happened. A lot of people got into multifamily not really knowing how it fully operates in terms of when you buy a property and the owner bought it for 70% less than what you bought it for. The increases in taxes, the increases in expenses. And I mean, I'm getting hit, but there are some people out there, even in the smallest scale, that are getting hit who say, I may have 50 doors, but they are suffering. And the person at McDonald's is making more than they're making, on a daily basis. And nobody wants to reveal that stuff. And it's starting to come to me now from my conversations with people about how many syndications are going belly up. And they're not spoken about very often because I guess just like anything, with social media. None of the bad stuff is ever spoken about. So
it's
that
not.
may be a good conversation for another time in terms of what happens when these things go belly up and why they go belly up. And I would love for someone, if anybody out there is willing to kind of share their experience of a syndication going belly up and, being honest with what happened.
There are challenges in every project. That's probably another reality, not necessarily a myth. It's just something to keep in mind. If somebody's sitting there telling you this, they've got this rap sheet that everything is perfect, like they're just lying or they haven't been in the business long enough, I can tell you every project that we have, something in there, there's surprises, there's headaches, there's little firestorms, shit storms, but like that's where your experience as a property management team comes into place and you just find ways to solve. And if your expenses are running hot over here, how do you correct it over there so that 3 years from now you kind of land where you need to be? That kind of recalibration is happening every day, and I'll admit it, and we can talk about it all day long. So that's an important point you make. I want to build on something else you said though about the amount of money they're making. I think that's a myth to just dispel pretty quickly for anybody on the operator side. So if you want to be a syndicator and you think I'm going to go get 1,000 units, I want to be a millionaire, it doesn't
Mm.
really work. It doesn't really work that way, right? Because to your point, so I remember very specifically, I was talking to a peer of mine in the industry before I went into syndications, and we were being a little bit forthright about the amount of money that we made, and I just isolated a pocket of units that I own in my hometown here, which happens to be 20 units, and I said, oh, I'm making this much a year off these units alone. He's like, and so he's a guy, he
Mhm.
had 500 units and he's already at 2,000, but he's like, you make way more money than me. So if you're aspiring as a real estate operator to make a bunch of money quickly and achieve a bunch of cash flow, there are other ways to do it. Syndication isn't necessarily going to be for you. It's a long game for sure.
Yeah, absolutely. I mean, in reality, it's a business and a job. You have a role. It's not passive by any means. It's something that you have to take on and be fully involved and spend fair amount of time on. But all right, let's keep it moving here. Moving forward. So part of your role with your firm is to drive economic analysis and investment strategy. What market indicators are you looking at when deciding on acquiring a new asset? And also, to tag onto that, you're kind of poking at the Connecticut market now, and I'd love to know what you see in Connecticut that's kind of bringing you this way.
Yeah. So a couple of things. So when it comes to a syndication, our investors are expecting a specific upside gain in a relatively short amount of time, 3, 5, 7 years. And that's
Yeah.
short in real estate terms. And so you have to look for specific indicators that make you confident that you're going to see that, you're going to be able to drive that upside in a short amount of time. And I say that very specifically because your strategy is going to drive what indicators you're looking at. So certainly
Mm,
you want to see that kind of population growth, job growth, and income growth because that's an indicator that demand is going to help drive prices and rents in the short term. And so you want to go invest in places like that. That's why a lot of people are deploying money in Dallas. But you want to look for areas where there's supply constraint and more affordability. And that's where I looked at the data a little bit differently. I said, we're going to Indiana. Because when you look at job growth and income growth, it's on par with the rest of the United States, which means you have a platform for growth in those local economies. And I'm talking about Indiana broadly as a whole is very,
sure.
very good. When you look at metrics for affordability in terms of home costs and just general cost of living overall, Indiana as a whole is one of the most affordable states to live in the entire U.S. Now, you've got major universities with over 200 high-tech degree programs in multiple cities across Indiana. They're churning out young college-educated professionals who are in their prime earning years, strong income, right? Lower cost of living creates this sort of this buffer, if you will, against rising cost of living that isn't necessarily
Mm,
being felt the way it is in Dallas, Texas. And let me explain what I mean. So I guess you can project rent increases with greater confidence because they have the room to afford it. There are
absolutely.
investors who will say, "Yeah, but in Dallas, the median income is 132,000 per household." I'm making it up, but it's somewhere around there, right? And I say, "Yeah, but the cost of living overall is so much higher relative to Indiana that it's no different than somebody who makes $80,000 a year in Indiana but lives in Dallas, right?" So you've got to
Mm,
kind of put it all into context. So lower cost of living, strong income, strong job growth really creates a platform for now. I know I'm going to get my rent increases with confidence because their wallet is not stretched to the max. They can afford it. So I know that my business plan is stronger in that sense. But then I'm getting in at the bottom of that growth curve in a market that hasn't necessarily exploded like a Dallas yet, but the signs are there, the early signs are there. So over the next 3 to 5 to 7 years, I might not see the same kind of parabolic growth, but I'm
yeah.
going to see good, incremental, steady, and predictable growth I can be confident in. And Indiana is a great place for that. And now, fast forward 3 years later, right? Indiana's stealing all the headlines. It's one of the few states in the U.S. which, over the past year, has seen positive rent growth. It's been stolen numerous headlines now as becoming one of the top real estate investment markets in the U.S. And we were lucky enough to see that data early on and get in there early. But that was because I was looking for a market that would create a greater upside opportunity and eliminate some of the risks that were being felt in some of the other markets in the U.S. When you think about Connecticut, I'm still doing syndications here, but I have a different sort of investor base who are a little bit less focused on upside gain because some of these guys are really wealthy. So they just want tax depreciation. They want
Mm,
lower incremental gain and they want stronger cash flow. And so then that drives me to a very different asset class that I look at different economic markers in terms of where I'm going. And I think the markets are falling back onto real estate fundamentals because over the last 4 years, the value add strategy has really been super profitable. But most landlords have squeezed the juice out of the lemon. They've all increased rents. They've sort of driven a lot of the expense out of the system. There's lower opportunities for really strong value add plays. And so you're going back to good old fashioned fundamentals. And what I mean by that is buy good real estate in good areas, manage it well, and then sit on it and let time do its thing. Take the depreciation,
absolutely.
take the appreciation, capture the cash flow, right? And I think that's where a lot of us are going to have to go back to. And I've got a lot of investors who are looking to play the long game. And so Connecticut's got a lot of great markets for that. A lot of great
Absolutely.
markets. So yeah. So
No, that's super good. My personal feeling of Connecticut is it's a smaller market, but it's restrictive in terms of the building that's going on. There is building going
yes,
on, but it's not like excessive building just because it's hard
that's
to
right.
build here in terms of regulation and policy. And we're well educated, high income earners in between two great cities. And so it's just a pocket until we start overdeveloping, which I don't see anytime soon. I think for me
That's
personally,
exactly
I
right.
still love Connecticut. Yeah.
That's exactly right. And so that's the big thing that I should have mentioned is what you mentioned. It's supply constrained. And when you look at
Yeah.
permits and new construction, we're not anywhere near where we need to be, and we're not going to be there anytime soon. So demand has never been stronger. It's a great time to invest in Connecticut. Yep.
Yeah. I actually just read a CoStar report just a couple of days ago trying to give my client information. And I think I forgot how many permits for new builds are out. and I think it's like maybe four something thousand, and it's still not even close to what Connecticut needs in order to fulfill the requirement. So, for the foreseeable future, we're still going to be good in terms of demand and whatnot. All right. So when evaluating deals in today's market, giving the fluctuating, well, not necessarily fluctuating, but the increase of interest rates since pre-COVID times, what are you looking at? What are you seeing?
Yeah, so well, I'll tell you what. So for us, we basically have three guiding principles that we've always leaned on, and I will give credit to Joe Fairless. It's really, I think it's something that he's preached for a long, long time, and that is when you're underwriting for a deal and you're going and you're acquiring, as long as you always have strong and adequate reserves, you're buying for cash flow, not for upside. So like, you're not buying into a deal where you're paying such a premium, interest rates are high, you're not really getting any cash flow. All the bet is on the upside. That's bad, right? So if you're buying for cash flow, you're buying with a plentiful reserve, so you never have to worry about a capital call, and you're buying with long-term fixed debt, then you're going to win in pretty much every scenario you could possibly pay out. And so for us, we've always taken that approach, regardless of what market cycle that we're in. It's worked really well for us, and I'll tell you why. And I kind of mentioned it, right? If you have adequate reserves, the risk of capital calls kind of always goes away. You're always going to have emergencies and unforeseen costs in your business plan. You want adequate reserves. For me, the buying for the long term, even if you have a 3-year exit plan in place, so what we'll do is we'll make sure we take out debt where there's maybe a 3-year step down or a 5-year step down with a bank, so we know there's a prepayment penalty in place, but it's smaller if we're going to exit sooner. And we factor in an exit penalty in our model. So if we ever were to leave a deal early and get whacked with a penalty, our investors won't feel that on their bottom line because we already factored in day one. And the reason why we do that is because the reality is, when we look at economic data, we can all feel pretty certain about, well, right now, you can't feel certain about anything. But generally, in most market cycles, you could feel good about the next 12 to 18 months just by where everything's at around you domestically and globally. But the further you go out in time, right, we call it the cone of uncertainty. It gets wider because any number of outcomes can happen. And so you really don't know. You might have like a 10-year exit plan in place. That's not common, but let's say you did. And if you had a loan in place where you couldn't exit until year 10, but a recession came in, in year 10, you didn't have an opportunity to exit, you'd feel the pain. The real problem is people who take out bridge debt and they're betting on a 2 or 3-year cycle, right? And then something like a COVID comes in. You don't have the opportunity to say, okay, investors, we wanted to exit at this point in time, but nobody wants to lose money. Good thing is we have a 10-year note in place. We're just going to ride it out. And if we can sell in year 5, 6, or 7, that's what we're going to do to optimize outcomes for our investors. So this short-term debt is really what creates the greatest amount of risk. So we always put long-term debt in place. So it's like, I always say, it's like you're giving yourself multiple exit points off the highway. So we're really not taking any undue risk with ourselves and our investors. So that's probably how I would say we approach every deal when it comes to underwriting and structuring the deal. So it doesn't really matter what we're seeing in terms of higher interest rates. Cash flow might be a little bit lower, but we know we can refinance into better debt later on if we needed to.
Absolutely. And I just find it so interesting how even at the largest level, how comparable it is to small multifamily in the sense of just fundamental buy and hold of properties and the simplest things such as reserves and having that in the account. It surprises me in this day and time how many people I work with who buy properties without reserves in the bank, not knowing just what is going to happen. It's not if it happens, it's a matter of when it happens and just being caught. And it sucks for individuals who at the smallest levels to not have reserves in the bank and lose a property and eventually sell at a loss just because of reserves but it's just so interesting how syndications are really, even though it's high level, it's still fundamentals in the end that you just have to follow by and not get too excited about it and whatnot. So very interesting. So, all right, let's keep it moving. When it comes to the realities of active versus passive investing, how do you compare the risk versus reward for both? Can you give some guidance on what may work better for one versus the other person or individual?
Yeah, listen, it really just comes down to capacity. And do you have the capacity to be an active investor, to not only take on all the responsibilities that you have as a landlord and stay ahead of leasing and tenant laws in your respective states, but do you also have the skin for it, right? The reality is tenants, regardless of what tenant pool you're renting to, these people will surprise you. They're not all clean. They're not all responsible, right? At times they'll make your life hell and they'll damage your units. If you have the stomach for that, being an active investor is great. It's going to be great for your portfolio. You're going to build a lot of equity and you're going to be able to capture cash flow if you're buying at the right cost basis. The reality is for most people who really aspire to enjoy the benefits of real estate, when they really get into it and they understand the work and the expertise, right? Because that's the other capacity component. You have the capacity to build the expertise to buy right. They don't have that, and they don't have the desire, and they don't have the appetite. They just want the money and the benefits. And so, for most people, passive investing really is the best route. Some people might say, "Oh, but I like this is my brother," and I hope he watches this. They say, "But I want all the equity." And the reality is, though, right? When you, especially in today's market with interest rates where they're at, and when you take the opportunity to buy at scale in a syndication, when you really look at the cumulative benefits of appreciation, depreciation, cash flow, and equity gain through a syndication, you can do as good or better, in most cases better, than if you went the
Absolutely.
active route and you bought on your own. And so that's something I think a lot of people need to just stop and really think about. So passive investing typically is the better route, and I'm not saying that selfishly. And if you were to ask most operators, what's the end game for them? They say, I'm going to get out of this business and take all the money that I've made as an operator and just be full-time passive because that's
Mm,
the ultimate end game, right? So that's how I'd answer that.
absolutely. I always tie what you do to buying back time for
Yeah.
individuals, especially high income earners who have a career, who are on a path, who decide they want to become landlords. And I really try to explain the differences. Me being invested in a couple of syndications now, I can kind of speak on it. It buys you time and it really buys you the same opportunity. If anything, you move faster through syndications if you have the funds to be an LP on the syndication. But for me, it buys you time, it buys you expertise, it buys you the team that you're going to work with. And really, you're really working as one big team. Initially, you may not be part of that GP team, but also it gives you the opportunity to learn and you'll see the operations and the reports that come back and the goods and the bads that come with it. And then ultimately you can decide if you truly want to start a business of real estate investing or if you want to just utilize individuals like you and your company to kind of take that for them while they continue their career. So
That's right.
it's definitely a conversation I think not everyone needs to really have. They almost need like a real estate therapist to talk to them before they get into this because it's not you can get wiped out in the first year just on a duplex. All it takes is one bad tenant and a couple of bad reserves that you didn't have, and then you're wiped out and you're done. So
Yep.
it happens quick. All right, Kris. So that's pretty much it in terms of the questions we had lined up. So we're going to dig into a few personal questions before we take off here. So when you're not currently syndicating deals, and also congratulations, I don't know if I'm allowed to announce it, but you left your job not too long ago. I was going to say while you're not syndicating deals and working your W-2, but that's a done deal. So while you're not syndicating deals and sourcing deals for your investors, what are some of your hobbies and things you enjoy doing?
Running marathons, so this is a marathon shirt, and actually, I always joke with people. You can guess what I'm wearing. It's usually some running T-shirt. Yeah, running, health, and fitness is just the biggest part of my life outside of real estate. It keeps me sane, keeps me strong, keeps me healthy, and I'm a big believer in remaining active. So you'll catch me in a gym or you'll catch me out on the streets.
Very good. How can people find you and or get a hold of you?
Big social media guy. I am a millennial after all. Facebook, LinkedIn, whatever their preferences are. I'd encourage folks to reach out, even if you have questions. I'm not going to push you any one way or the other. I'll answer them very unbiased. Yeah, I've had a lot of people step forward to help me and mentor me over the years, so I'm very charitable with my time and even artifacts. If you're an operator and you need a pitch deck for investors because you're trying to close your own deal, I'll give you pitch decks that I built for my deals, right? If you're an
Hmm.
investor, you're thinking about investing in somebody else's deal, I won't be offended if you ask me to just audit it for you and poke holes in it. I'm happy to help educate and provide third party thoughts. So, leverage that, reach out, find me on social media, and I'll answer your questions.
Absolutely. And I'll make sure I plug in all your social handles here so people can reach you or find you. Any final words for the audience before we take off?
Yeah, listen, if you're thinking about real estate either passively or actively and you're not already in the game, just get in the game. Just remember, you don't make money timing the market, you make money by getting in the market. And real estate, I selfishly believe it is the greatest business model out there today. So, get in it.
Absolutely. All right, everyone. Thank you so much for joining us for another episode of The Agent Investor. First off, Kris Morin, thank you so much for joining us. It's been a pleasure being buddies with you and establishing our relationship over the last few years. And to our audience, thank you all for tuning in once again to another episode of The Agent Investor. We want to wish you the best in your health and happiness. And until next time, we look forward to seeing you on the next one. Everyone, have a good one.